Okay, it's Saturday, March 14th. Market's closed. I wanted to take this a few moments here to talk about one of the last trades that I executed with the trade copier. It was here on the pound dollar, and it was based on this daily time frame setup. So I'll quickly review what I'm doing here so that you can get up to speed with my expectations. This is, again, the pound dollar daily time frame. And the indicators that you see here right now on the screen are the Bollinger Bands, and I have a 5-day moving average. And I'm using the Fibonacci tool. So back in December, we had this peak with Brexit. We traded this continuation breakout trade, me and my coaching students in the chat room, during late November into December, again, with the expectations and the outcome with Brexit. And that printed this A high and that B low, and then there was that C retracement. And then things went sideways for quite a while here, as you can see. And I was waiting for a continuation sell signal candle. A continuation breakout trade is a technique that I developed back in 2001. It was the first strategy that I put together. And basically, it involves identifying a range of consolidation and then waiting for the candle that breaks out of that consolidation, whether it's to support or resistance, confirming that candle, and then making sure that it leads to, or confirming to make sure that it leads to, the trending move that develops in the direction of the breakout. So as you can see here, it gets a little bit choppy for obvious reasons. I'm not going to review all of the economics and the things that went into all of this price action over the last few months. We all know what went on. You were there and you traded it. But the analysis and the structure using this Fibonacci tool remained intact and continues to develop trade signals and opportunities and take profit levels as I expect it to. So I see people often using the Fibonacci tool. First of all, I'm not going to say that they're doing it incorrectly. That would be my opinion in some situations where it would clearly not help them find a target or an entry or anything. It'd be just because they're dropping it in at some of the most inappropriate locations. But sometimes, you know, you can use it incorrectly, but if you use it a specific way and it works, then obviously that's how trading is. Sometimes you can break the rules. I'm not saying to break the rules. What I'm saying is sometimes you can break the rules and some of the trades will work out anyway. And you need to be careful. Be very careful and be very selective about how you use some of these tools. So I use these tools like the Fibonacci tool to find extension targets like this, price targets, if I'm going to trade it to the, you know, whatever direction it breaks out in. And then I leave it alone. And I tend to find some of the better moves and the more reliable price targets based on the daily time frame. I know it's tempting to switch and want to go down to, let's say, like a 5-minute, you know, sometimes you can do it with a 5-minute and it works out okay. Again, you know, if that's what works for you, that's okay. There's nothing wrong with it. All I'm saying here is that this is how I use the tool and this is where it works out the best for me. And it gives me opportunities to trade even on an intraday basis, meaning that I can still execute trades like the Tech 1 trade, the continuation breakout trade, the HL30, the London breakout, things like that. I can trade all of those, but still be paying attention to the bigger picture here and knowing where my take profit levels are. Because once price eventually hits one of these extension targets, that's usually where price tends to slow down, go sideways, and at that point I call this particular setup over with. Again, it's my setup. Not that the market has to listen to me because there's so many different ways to trade. It's just my particular trade setup that I have to find a beginning, a middle, and an end to the trade. And I have to honor that, respect that, and know what happens once it hits its targets, that I need to be taking profits at that point according to my trade plan, or I'm not following my trade plan, and then all kinds of hell can break loose, right? I can end up letting a winning trade turning into a lose trade. All kinds of things can happen. So this setup here that you can see, this was the first take profit level, and this Fibonacci tool and the drawings here, the technical analysis that you see, all of this has all been in place all through December and all through January and February. I haven't moved it. I haven't adjusted it. It's always remained here. Here's the A high. Here's the B low. There's the C retracement. There's the first extension target at 1.2522. There's the final extension target at 1.1915. These are price targets that I'm expecting to trade it to. Now, I will get in and out. Now, again, if I have a signal and a setup, and let's say I'm trading a separate account, and I want to trade off of the daily time frame, I'll do something like that as well, and I'm still in this trade. But I can also use this information and find intraday trades like off the 30-minute and the 1-hour chart. That way I'm making money every day. So I can set up 2 separate accounts and I can trade it just like that. And those are the trades that you see me execute with the trade copier. So I would expect more of the same, meaning that this move here, and I know that this gets pretty challenging and a lot of people start looking for bounces. But when we see a trending move like this, because it's had 4 or 5 days in a row to the downside, or even 3 days, that's not enough to say that it's going, it's due for some kind of a bounce and a retracement or a correction, whatever it is you want to call it. I mean, some people use those words in the wrong way, but they're describing basically the same thing. Some kind of a bullish retracement or pullback, the opposite direction of this trend. Obviously, we're going to see a day or two along this downtrend where we're going to get some kind of an opposite move, something bullish. It doesn't have to be a big move. It can just be some kind of a move like that where we need to realize that's a possibility. And that right there, the fact that it does that, if there's one of those days and you're not paying attention to the timing in your entry, you could get stopped out pretty quick. Even though you might be right in the direction that you're trying to trade it in, it could just be that your timing is off and the stop loss that you use isn't going to keep you in the trade and you have to prepare for that. However, I still expect more to the downside. The indicators that I use here are clearly indicating that this is likely to continue a lot lower. Again, that's my target, the 1.1915 level. I see no reason to expect that it's not going to work. Now, if at some point in time it stops and bounces, and then all of a sudden I get 2 or 3 days and it looks like it's some kind of a correction or some kind of a deeper retracement, then I might reevaluate my expectations here and my analysis. Because at any point, I'm willing to say, hey, things are changing, and I'm done looking at it in this way, and things have reversed. Now I've got different signals. I'm more than happy to change when I get the confirmation. That's what trading's about. I'm not going to be married to my position and say, no, 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 it has to go down here because here's my target. That's ridiculous. Like, that would be really irresponsible for me to trade. I'm here to make money, not just to, insist that I'm right on all of these trades. The fact that I have these extension targets, they work, and they work probably 90% of the time. But I know that there's going to be some off occasional time where, everything just changes because that's how the market works, and the analysis changes as well. So be careful with that. But I do expect that price is going to continue a lot lower. Now, on Friday, initially with the London Open, I had the London breakout trade to the downside, and then later in the day, and let me show you what I was doing here. Later in the day, on this daily time frame, I was able to trade this in the direction with all of the reason I showed you this whole scope, this whole bigger picture here, is I want you to see where all of this set up and why I expected it was going to continue to go lower when it took out Thursday's low. The daily candle on Thursday, the low, as price was taking out the low, gave me another entry opportunity. That is also another entry opportunity, along with looking at volume, along with looking at these indicators. I also have another one here. This is the let's go back over here. I'm using a different indicator down here to help me confirm this move to the downside. The indicators are also very important. When you start picking some of these indicators, you want to make sure that you're using the right indicator for the right task. It's like using the right tool. Right? Sometimes I see people, they're using indicators that are not necessarily helping them, or they'll have 3 or 4 indicators that are all doing the same thing. And they're looking for multiple forms of confirmation, but what they're really getting is double or triple confirmation. So be careful about that. Be careful about the indicators that you select. Make sure that you're doing that. Sometimes, you might see somebody that's using 2 different indicators, but maybe they have 2 different types of setups. So that would be okay. That would be perfectly understandable in a situation like that. But just be careful. Make sure that you're using the right indicators that are going to help you confirm trending moves. How long you should hold on to a trade. When should you expect some kind of a bounce or a retracement? I know that after a few days, people start getting, pretty... Their expectations are that it's pretty oversold or overbought in one particular direction or the other, and then they start looking for a bounce. And I know that people do that because I used to do that, and a lot of people do that. And I still see people on Friday, they were looking for some kind of a significant bounce here on the pound dollar, and for no other reason other than they saw 3 or 4 days to the downside, and they were thinking this is really oversold, and maybe they heard somebody else say it or read somebody else their comments about that they think that the pound dollar is oversold. This can go on for a while. This does not need to stop like this. And one of the other facts that you need to learn and you need to understand when you're studying and you're learning the markets and the behavior, you can't just simply go off of, these really short time frame ideas, where you're looking at 2 or 3 days to the downside and you think, well, it's due for a bounce. It's got to stop. It's oversold. Thinking these thoughts without having any proof and not scientifically testing anything and not understanding the overall bigger picture is not going to help you. You're just going to end up exaggerating your losses. If you're going to make money in this business, you're going to have to take it serious and you're going to have to study and you're going to have to start doing things like tests that you would have never really thought about doing before. I come up with all kinds of different ways to test the markets and to test the behavior and the structure, and they're ideas and thoughts that I had not had or thought of testing before. And I learn something new every single time I do something like that. One of the things, though, that I do on a pretty consistent basis with a lot of my coaching students is we'll go back and we'll take like a block of time, whether it's a quarter, half the year, 1 full year. We're measuring 5 years. Maybe we're going back just 1 30-day period and trying to look at, what did Mondays do typically? What at this time of the year? What did Tuesdays do? How did they end up closing? Is there a percentage? Is there something that we can track? You have no idea what the results are going to actually produce and show you until you actually start taking some of those ideas and testing them. And it does take a lot of work. It does take a lot of time. You won't go out. You won't watch TV. You won't be doing anything other than just testing. But how bad do you want it? How bad do you really want to study and learn and understand the markets? And the reason I bring that up is that this move right here, I know happens a certain number of times during the year. And it's not something that we can always expect. You can see the way the consolidation moved here all through January, February, March, the beginning of March, before it let go. And I know that the markets are going to produce a certain amount of consolidation and trading range activity like this that I can anticipate and expect, and that my indicators are going to no longer work, or at least the indicators that help put me into some kind of a trending move. I need to shift my thinking when I see consolidation and start using other indicators and start using other strategies. And by doing this testing and understanding how often how likely it is that price is going to remain inside of consolidation versus trending moves. And if it's a trending move, is it just going to be a short trend move, or is it going to be something that's going to be exaggerated and continued for quite some time? You don't want to fight the trends. By having this ability and the skill to be able to read the markets, you will stop fighting the trends and stop thinking, oh, this is already, really oversold. It's time to start looking for some kind of a bounce. When you do that at the wrong time, you're going to get stopped out quickly. And again, if you're just feeling that or just thinking that without any scientific testing and not studying the markets, you're not helping. You're really going to find yourself in a position where you're going to get really frustrated trying to fight trends. So I wouldn't recommend fighting any of the trends here that we see here on the pound dollar. I wouldn't fight this trend right now. I don't think it's going to stop. I do expect bullish retracement days and pullbacks. There could be Monday where it pulls back. There could be a strong pullback. But as far as the direction and the trend, you've got a high and a low. I don't have a low set in yet. I still don't have a low. Relative to this time frame, I don't have a confirmed low yet. This is going to go on for a little while until I get confirmation. Maybe this Friday, maybe yesterday was the actual low, and maybe Monday and Tuesday will print some kind of a 2-day candle, 2-day reversal, that kind of thing. And then at that point on Wednesday, I could say, okay, well, there's a confirmed low. Now I've got a high and a low. But until I have confirmation, I've got no business trying to guess that this is going to turn around. Now, sometimes you're going to be right trying to pick tops and bottoms, but you can lose a lot of money by doing that. And right now, what this is telling me is that this is likely to go a lot lower. That's all I'm going off of right now with the close price. This is likely to go a lot lower. Be careful, be prepared for some kind of a bullish retracement, but this is likely to go a lot lower. So again, that was just the move that I did, the last trade that I had on Friday. I just want to show you how, identifying the trend, confirming the trend, having this information and the skill to be able to read the markets, and knowing, for me in my case, it was that I've had this structure here, knowing where price is likely to go once it gave me confirmation based on everything that I see here, three pushes to, I'm sorry, yeah, three pushes to a high, the A high, B low, C retracement using the Fibonacci tool to identify my extension targets. I left it alone. You know, a lot of people would draw it from here to here, all kinds of different things. I used it in the most appropriate way. This is clearly the last high. This is clearly the low that formed. All of that information comes together, and I'm not fighting it. I'm not fighting it at this point. I'm just going to leave it alone, and I need confirmation if I'm going to change my mind. And this gave me a perfect opportunity to take 2 trades to the downside on the pound dollar and earn a lot of money as a result of that. And you're going to get opportunities like that. I can, you know, drill down to the 1 hour or 30-minute time frame and pinpoint my entries. Now, my take profit levels on a situation like this, again, as I mentioned, I can have 2 separate accounts, which is what I would recommend anybody doing. If you're going to be trading off of a daily time frame and then you want to trade for fast action, fast activity, 30-minute, 1 hour charts, you know, intraday, have a separate account. Some people will obviously combine both, but I like to leave them separately. And it just gives me more clarity, more focus as to what I'm doing. I don't get confused in the heat of the moment. Sometimes it's easy to make a mistake and fire off a trade in one account. You didn't mean to do that. And then you have to go back and figure out what to do next. Just keep them separate. You want to eliminate any possible distractions and any possible mistakes that can develop in the heat of the moment when there's a lot of activity and there's a lot of things going on. But again, I would expect that this is likely to continue to go lower. The 30-minute chart and the 1 hour chart is what I used to execute the trade on Friday, the last one here on the pound dollar. And I used psychological levels. So at that point, I'm using psychological levels for intraday trading. And the psychological levels don't necessarily help me when I'm trading on the bigger picture, right? A bigger time frame like this, I'm going to be using, when I can, the extension targets like this. But on a 30-minute or a 1 hour chart, I'm going to be using psychological levels. It's just a lot easier. They get hit all the time. I mean, they repeat all the time. It's just a natural take profit level, target, place to lock in profits. And they usually provide anywhere from 30 to 40 or even 60 pips profit on an intraday trade. So they're very good targets. I'll talk about those targets throughout the week and throughout the months. I have videos in the membership area that will walk you through how I use psychological levels as targets.